Welcome to the Tidecrest Market Navigator for May 2025. During these short monthly videos, our goal is to help you analyze important economic data and understand shifts in the capital markets. Let's jump right in. First, we're going to talk about the equity markets. We'll start in the U.S. We like to look at the main U.S. equity indices each month. We're really talking about the S&P 500, the Dow Jones, NASDAQ, and the Russell 2000 for the small cap. So as you can see on this chart right here, all the U.S. equity markets, kind of major indices, are down on the year. You can see kind of a wide range in terms of how they're performing. You can see Dow Jones is technically doing the best, down close to 3%, closely trailed by the S&P 500, and then significantly lagging behind is NASDAQ and then the Russell 2000 small cap. Next, I want to talk about U.S. versus international equities. We're going to look at, on this chart, we're going to show the S&P 500, the MSCI EFA, which is really, think of it as developed international countries, and then emerging markets. And so what we're looking at here is that for the first time in a long time, international markets are outperforming U.S. quite substantially year to date. So you can see that up there in the orange line, the EFA is up almost 12%, emerging markets is up almost 7%, and the U.S. is down, like we said on the earlier slide, about 3%. So this shows a lot of kind of part of the story this year is diversification is working quite well. Specifically international stocks are carrying the weight for a lot of portfolios. There's some other areas like bonds we'll talk about in a little bit. Precious metals are up. We're not going to talk about gold today, but it is up substantially on the year. So there are some other areas that are helping on the diversification front within the portfolios. And then the last slide we'll talk about in terms of equity performance is growth versus value. So, something that's not uncommon to see during times of stress in the market is value will outperform growth. Again, we've been in a period of time over the last 10 to 15 years where growth has generally outperformed value pretty meaningfully. What we're seeing this year is values almost flat in the U.S., and then growth is down 7%. Again, you can see the volatility on this chart. It was substantially lower earlier in the year, back into April, but so far, you're continuing to see outperformance of value over growth in the U.S. And then real quick touch on volatility. You can see that we're well off the peak. This is the VIX. And so what you can see here is that earlier this year in April, we hit a high of 52, which is substantial, the highest we've seen by far over the last year, meaningfully higher than what it was last August. We had the yen carry trade volatility. But now we're talking about a 20-year chart. If you look at this one, and this shows kind of some context, you can see the big spike of 82 during COVID, then you go all the way back to 2008, the financial crisis. So there's been some periods that have been higher than they were in April, but not many. Really, this is the third highest spike in the VIX and the volatility index in the last 20 years. So let's jump over to interest rates and fixed income. Always like to look at the Fed and the Fed rates. This has kind of been a story lately. Obviously, administration wants the Fed to cut rates. Fed's trying to hold its ground and not cut rates, feels it's not necessary right now. You can see, rates have come down a little bit from the peak of where they were, but they've kind of started to flatline. But you can look on this chart, the projection is that rates will eventually come down, that we believe that's the path, but we don't think the rates are going to come down as quick as people had originally anticipated. And so we think we're going to see that. I think the general consensus in the market is that you're going to see rate cuts, maybe 1 or 2 this year. There's a lot of different variables that kind of go into making that decision. We'll have to wait and see. This is the yield curve. This really shows, if you look at the dark blue, that's our current yield curve. You can see the front end of the curve is still inverted, meaning the super short-term yields, like let's say the 1-month yield is still slightly higher. The 1, 2, 3-month yield is still slightly higher than like the 1 and 2 year yields, but it does get more normalized once you get kind of past that 3-year number. But if you look back at some of the previous time periods, we won't go through them all, you can see substantial inversion in July of 2023, and then really kind of a flat yield curve in October. And then you go back to COVID, where rates were almost 0 at the bottom of the chart there. Bond market performance, we use some proxies here, but it gives a feel for what's going on in the bond market. So far, we're looking at year-to-date numbers, and these are all U.S., and I won't, again, go through all of these, but you can see, if you want to pause and look at this, you can see that all the major bond kind of segments of the market, for the most part, are up on the year to varying degrees. And so, again, it speaks to the diversification and the value there by having a portfolio that has stocks and bonds and international and domestic and growth and value, et cetera. And so that really plays into the way that we like to structure portfolios, and that bond performance year to date reflects that. We'll look at inflation. This was something we didn't talk about for years, and it's really been a main story for the last probably 3 or 4 years. But before that, it was probably a decade before people really paid attention to it. But it's still a main story. You can see here, substantial drop. March, it was down to 2.4%, getting very close to what the Fed's trying to target, which is a 2% target for their inflation number. And we can see progress, which is great. We'll kind of wait and see how tariffs may impact this in the coming months. I think a lot of expectation as it starts to creep back up a little bit. But when you look at it on the next chart, you can see that the high was about 9% in 2022. So we're well off that high. And you can look back into the 80s and late 70s. You had in the teens on inflation. So we're not near that. So all in all, I think we're making good progress on that. We'll just keep an eye on it as tariffs may impact inflation. And next is unemployment and wages. Really what we're talking about here is unemployment rate has been below historical average for a very long time. And wage growth has been above average for quite a while, really since COVID. And so what the Fed's looking for is a cooling in the labor market to feel comfortable that we're not going to have a flare-up of inflation. This was kind of one of the main data points before the tariffs became one of the main talking points recently. So the Fed's still watching this. You can see these lines at the bottom right are starting to cross over. So you can see wage growth is finally dipping below unemployment, the unemployment rate, meaning unemployment's creeping up very slowly and wage growth is dropping, which is what we want to see, or the Fed wants to see, in terms of normalizing before they're going to make any cuts. Definitely one of the components they're paying attention to before they cut any rates. Consumer confidence. This is a chart that we look at really every month. We have it for many years. It's a kind of a lot going on, but I think it's fascinating when you dig in. So University of Michigan puts out a survey. They're doing a consumer sentiment survey. They've been doing it since 1971, and they reach out to people and ask how likely are you to make significant purchases. How confident are you as a consumer? What's happened since 1971 is when you see this index bottom out, you tend to see outperformance in the stock market beyond that over the next 12 months. And so you can see in this chart, when you've seen these 9 sentiment troughs, the average performance in the S&P 500 is 24% over the next 12 months. So what you see here is we're hitting a pretty significant trough here in April of 2025. You probably felt that as a consumer, as an investor. You saw the volatility in the market. So you can see we're in that trough. Again, this is just one of the things that you might look at when you're talking about allocating a portfolio. I think of it more as, if you're a long-term investor, don't let these drops in sentiment and drops in confidence and increase in volatility in the markets really shake you from your long-term path. Just making sure you have a diversified portfolio, because historically these dips in confidence coincide with dips in the market and increases in volatility. And then historically, again, over the last 50 years, it's been followed up by reasonable equity performance that people usually like to be participating in. Yeah. So last I want to touch on chart of the month is going to be the US dollar index. So it's meaningfully down on the year, 8%. That's a big move for the US dollar. It really reflects international investor confidence in both the stock and bond markets of the US. It also helps with the diversification theme that we've kept talking about, which is if you're a US investor who lives your life in US dollars and you're investing in international stocks, a lot of those are going to be denominated or held in foreign currency. You're going to see some outperformance purely based on currency valuation. And if US dollar is going down, then the relative value of those other currencies could be going up most likely. And so you're going to see performance on currency. And then also in this particular case, loss of confidence in US equity markets based on the uncertainty around tariffs, flow into these international markets and confidence moving there and dollars moving there. And that's why we've seen, part of the reason we've seen outperformance in international markets is because the move down in the dollar index. Thanks again for watching the May 2025 Tidecrest Market Navigator. As always, we appreciate your time. Please like the video. If you want to see more content like this, subscribe below. Follow us on Instagram, connect with us on LinkedIn. And of course, if you want more information about Tidecrest, you can go to our website. The link's included below. We'd love to hear from you. Reach out with any questions. Till next time, thanks for tuning in.